Good afternoon, everyone. This is John Swolst. I'm the CEO of Inside ETFs. We'll be getting started just about 2 minutes or so from now with our part 2 of our Inside ETF Canada webinar series. We'll be taking a look at liquid alts, the key to hedging equity exposure. So again, we want to give those folks that are dialing in a touch late the opportunity to go ahead and get in before we get started. So we'll touch base with you guys in just about 60 seconds or so. We'll be ready to begin. Thank you. For those of you who just joined, we're going to give it about another 30 seconds or so to allow some folks to go ahead and get dialed into the webinar, and then we'll kick things off with liquid alts, the key to hedging equity exposure. So just bear with us for about another 30 seconds or so while we let the last few folks go ahead and get dialed in. Good afternoon and hello, everyone. My name is John Swolst. As I said before, I'm the CEO of Inside ETFs, and I'll be your host for today's webinar, Liquid Alts, the Key to Hedging Equity Exposure. This is part 2 of our 5-part webinar series. We're covering actionable ideas, new solutions, and new insights that you can use across any asset allocation. Today, our theme has been focused on liquid alts and removing the uncertainty and downside risk from your client portfolios. As we all know, from mid-February to the beginning of April, things were rather volatile in the markets. I'm sure you had some sleepless nights. I'm sure your clients have had some sleepless nights. So we thought it'd be really cool to go ahead and kick off the first day of our webinar series, taking a look at how we can remove some of that risk, mitigate those that downside from your clients' portfolios. So we're going to talk a little bit about infrastructure. We're going to talk a little bit about liquid alts today. So we want to make sure that over the next 50 minutes or so that we make this as interactive as possible. So please do feel free to go ahead and submit questions. We'll try to answer those in real time. If not, we'll certainly do our best to get to them at the end of the webinar. So joining me today is Bill DeRoche and Mark Stacey of AGF Investments. These are two folks who have a mountain of experience when it comes to liquid alts and infrastructure investing. So I want to go ahead and dive right in. But before we can do that, we need to go over some housekeeping items to make sure that your webinar is the best possible experience for you. At the bottom of your audience console are multiple application widgets you can use. If you have any questions during the webcast, you can click on the Q&A widget at the bottom and submit your questions. As I said, we'll try to answer them live during the webcast, but if a fuller answer is needed or we run out of time, our speakers and sponsors will do their best to follow up. We do capture all of the questions. If you want to expand your slide area, you can do so by clicking on the maximize icon on the top right of the slide area, or by dragging the bottom right corner of the slide area, allowing you to see the slides in a more fuller view. Many people always ask, is there an on-demand version of the webcast? Yes, there is. It will be available in approximately 24 hours after today's webinar has concluded. You can access that on-demand version of the webinar using the same audience link you used to join us today. And again, you should see that within the next 24 to 48 hours. An email will be sent to you, making you aware of when it is available. Like I said, I'm joined by two industry experts with a mountain of experience. Both of them are representing AGF Investments, a true leader in the liquid alt space, at least in my mind for sure. When I think liquid alts, I think AGF Investments both in the U.S. and up in Canada. So our first speaker is going to be Bill DeRoche. He has an MBA and a CFA charter holder. He's the Chief Investment Officer and head of AGFiQ Alternative Strategies at AGF Investments. As I said, he is the Chief Investment Officer and head of their alternative strategies. He is also the co-founder of AGF Investment LLC, a Boston-based investment advisory firm founded in 2009 and a subsidiary of AGF Management Limited. He is the leader of AGF's quantitative investment platform known as AGFiQ. AGFiQ's team approached its AGF's team approach is grounded in the belief that investment outcomes can be improved by assessing and targeting the factors that drive markets and that drive market returns. Bill has a long tenured experience employing quantitative factor-based strategies and alternative approaches to achieve a spectrum of investment objectives. He will be joined by Mark Stacey, a Senior Vice President and Co-CIO of AGFiQ Quantitative Investing and Head of Portfolio Management. Mark leads the firm's investment management functions for AGF's quantitative investment platform, AGFiQ. Again, their approach is grounded in the belief that investment outcomes can be improved by assessing and targeted factors that drive market returns. In addition, Mark is a member of the Office of the CIO, a leadership structure within AGF's investment management team that encourages the further embeds collaboration and active accountability across the team. Across the team and the broader organization. Apologize for that, gentlemen. I lost my train of thought there. So we want to go ahead. We want to get things started right away, as I've already taken up 5 minutes of this webinar and no one is here to hear me. But before we do that, we want to take a quick poll of how people are currently using liquid alts or thinking about liquid alts. So if everybody could take a minute to go ahead and answer our polling question, it'd be greatly appreciated. Again, it's, are you currently using or considering using liquid alt strategies? Yes, I am considering them. No, not at this time. I am currently using them. Not applicable due to licensing. So take about another 30 seconds or so to go ahead and weigh in. Then we'll take a look at our results. And from there, we'll be able to go ahead and get started with our conversation with both Bill and Mark. All right, guys, just about another 10 seconds or so to go ahead and submit your answers. And why don't we take a look and see what we have from a polling result. So, wow, I'm a little surprised here. Great to see that 54% of the audience is using them. And then we're seeming to be split between the no, not at this time. Yes, I'm considering using them. So this is a perfect webinar for you guys. For the 18% of you that are using them, that's fantastic. It's a great way to stay on top of what's going on in the market. And hopefully some folks that are not using them at this time learn a little bit something on this webinar and start to put them into their portfolio. Bill and Mark, I want to throw this out to you guys. Do these results seem fairly common to you? Is this a little bit outside of the normal? Do 54% of the advisors you talk to already use alternatives?
So I would say this is very consistent what we see when we go out there. Liquid alts have been around for quite some time now, so we do have a pretty loyal following of folks that do use the products that we have. We've been offering liquid alternatives in the U.S. now for almost a decade, but we're finding that it's still very new to a lot of advisors. So there's lots of room, opportunity to continue to grow.
Yeah, and I would just echo Bill's comments, and I think obviously with the type of markets we've had in the last year or so, that advisors are looking for ways to add on something that's slightly different to their portfolio that can help in these portfolio during times of volatility and uncertainty. And that doesn't surprise me that we're seeing more and more advisors considering liquid alternatives, particularly with their launch in Canada, back last year, in June of last year.
Yeah, right. We're only talking about, 18 months or so in the market up in Canada, so hopefully we can provide a good bit of education today to help push that number closer to the 100% rather than the 50%. So with that, Mark and Bill, you guys ready to go ahead and get started?
Absolutely.
Yeah.
All right. Well, here we go. So I think we'd be foolish not to start if we didn't start to look at the uncertainty in the market. I think today was a little bit more of a volatile day than we've seen over the past few weeks. So why should advisors, investors be looking to add alternative ETFs into their portfolios?
Well, the main reason that folks typically look to add alternatives to their portfolios is, one, to improve the returns of the portfolio, and second is to add something that's uncorrelated to the return streams they have in the portfolio so it can reduce volatility. The issue that we tend to run into is that this area is very diverse. You're typically grouped into either liquid alternatives or alternative asset classes if you're not core equity or not core fixed income. So you can end up with a very wide range of strategies that fall into this group. So it's very important that you understand what it actually is that's driving the returns associated with these strategies. As I mentioned, there are two ways that you can benefit from these products. One is to improve your average returns, and the other is to reduce volatility. If we do a little bit of arithmetic, we can show that your cumulative wealth will benefit. Obviously, it's pretty easy to see how higher returns can help, but lower volatility is the second way that you can actually increase your geometric return, which is how you get more money at the end of the day. Very important.
We all like more money at the end of the day.
I would, yeah, yeah, absolutely.
Go ahead, Mark.
John, I would also say, one of the reasons why you want to think about alternatives and liquid alternatives at this point in time is, we've seen, obviously we've just gone through a very volatile period, which you talked about. And, during those periods of volatility, the traditional assets that we've normally put in our portfolios, the equities and fixed income, they do tend to increase in volatility and they tend to increase in unison. And so that means their correlation is increasing as well. So as Bill mentioned, one of the reasons why advisors should be thinking about alternatives at this point in time is the liquid alternatives are a chance to put in something that either has low correlation or negative correlation to your portfolio. And we think about going forward, no one knows how the COVID crisis is going to play out, and we're likely going to have many ups and downs, and that's going to be periods of volatility, periods where our traditional portfolios start to correlate together. And so that's, from our perspective, all the more reasons why you might want to consider having alternatives in your portfolio.
Yeah, I think if nothing else, we saw, like I mentioned, that 6-week period, that 2020 is probably going to be a little bit different than the past sort of decade of sort of straight up that we did see. But one of the things that Bill mentioned, right, is that you tend to get sort of lumped into this bigger bucket if you're not core equity or core fixed income. Can you guys talk to us a little bit and maybe explain how those different approaches within alternatives work with ETFs? So, what distinguishes one alternative from another alternative ETF?
So we brought two examples here, and one of them is a strategy. Strategy typically means that we're going to use both a long and a short portfolio, some combination thereof, to create a return stream that's different from core equity and core fixed income. The other way that folks try to get around this is by using an asset class that has very low correlation to equities and fixed. So we're going to give you two examples of how to tackle this. One, using a long-short approach. It's also different in that it's more of a diversifier or a volatility reducer versus a return enhancer. And then we're going to give you another example that focuses on the asset class case.
Fantastic. Well, looking forward to digging into that. So, Bill, I think we want to focus a little bit first on liquid alternatives. So I think we talked about, the benefits of using this strategy, but is there benefits to a strategy that holds long U.S. equities with a below average beta and short securities with an above average beta? How does that work, and what are the benefits of doing that within the portfolio?
Yeah, so whenever you're building a strategy, you need to have an investment thesis. And then you basically have to figure out how it's going to fit into the overall portfolio. There's been a very well-documented anomaly. It's referred to in a lot of the literature as the low volatility anomaly, where low volatility equities tend to perform better than expected in terms of their betas versus their high beta counterparts. So that's been well documented. So we were looking to create a strategy that capitalized on this anomaly. The second part, though, was how does it fit into the overall portfolio? And one of the other observations that we made was that for most people, their biggest exposures are to core equity as well as core fixed income. We all know that equities are a great way to create wealth. It's worked very well for a very long period of time. But every decade or so, equities tend to have a large drawdown type event. We think of it as what we call the left tail. So if there was a way that you could hedge some of that left tail, some of that drawdown that equities tend to experience without giving too much of the upside away, you could then basically end up with more cumulative wealth by basically mitigating that volatility as we were describing. So step one, we identified an anomaly. In this case, it was that low volatility anomaly. Step two was analyzing client portfolios. And for the most part, what we saw was there was a strong exposure to equities and fixed income. So how could we help them fix some of the issues that we identified with regards to those exposures and do it so that they only needed to, say, buy one fund? If they only had one alternative that they were going to access, what should it be? So in this case, we look to basically create this insurance product. It's definitely an insurance product because, John, as you said, it actually has a negative beta. So at the end of the day, what we elected to do was basically have an equal dollar exposure on the long and short side. So you can imagine we're long low beta securities, we're short high beta securities. Well, the net beta of that exposure is actually going to be negative. So the expectation is when the market goes up, this fund will lag some, but when the market goes down, it will hedge the negative market returns that you generate. Now, the big thing to remember here is there's an asymmetry that we're picking up on. So when you think about it, the market typically goes up in very small increments. We like to use an analogy that the market goes up like an escalator. Volatility tends to compress, it gets lower. Because it's a long-short portfolio, we're trying to capture that spread between the long and the short. With lower volatility, that spread's going to compress. So the short portfolio, which is the high beta names, though it will outperform that low beta portfolio as the market rises, because the spread's compressed, that underperformance is somewhat small. And we measure that with what we call an up capture ratio. So in this case, an expected up capture ratio for a product like this, using round numbers to make the arithmetic easy, if the market were up, say, 10%, the expectation would be that the fund would be down 5%. But what we know, and we've seen it consistently throughout time, is when the market goes down, volatility tends to spike. We've seen this recently with the VIX and just realized volatility, and the market drops, we call it drops like an elevator. It's pretty dramatic. There were a lot more big down days than big up days. And as a result, the spread between the long and the short portfolio widens dramatically. That long portfolio significantly outperforms that short portfolio. The down capture ratio approaches minus 100%. So when the market is down 10%, the fund is up 10. So the idea here is the asymmetry that happens because of this market anomaly, where volatility gets much higher when markets go down, is what we're able to capture, and we're basically able to provide that insurance at a fairly reasonable price at the end of the day. One of the very attractive elements, and we can look at the slides here on page 7 just to highlight a couple of the points, is that we're not focused on the expected return of this particular strategy. As we all know, returns, they can be positive, they can be negative, they have a very wide range. We're more focused on the correlation, and in this case, the correlations are very stable as well as the volatilities. So the fact that we know we have a negative correlation to the equity market in general is we're going to be able to provide that hedge. So if we were to move to slide, I guess it's 10. I guess I can do that. If we were to move to slide 10, you can see that since we've been live in the U.S., we've been able to, anytime the market has been down as measured by the S&P 500, the fund has actually been up. So the premise that we're able to provide insurance is very much intact. If you were looking at the fund over, say, from the February market high through the low, you would have seen it did exceptionally well. So a couple of very important points there that we discussed. One is making sure you have an investment thesis, and this time we talked about the low vol anomaly. Two, once you have an investment thesis, figure out how you're going to fit it into existing client portfolios. And then three, just making sure that you can communicate how it's going to work. Are you trying to increase returns, or are you trying to lower volatility? And in this case, we're trying to lower volatility. So a very interesting strategy, probably different than what a lot of people have seen in the past. John, I'm going to turn it back to you, see if you have any questions.
I do, actually. So one of the things that comes up, right, is are you guys sort of like for like? So if you're 50% of the portfolio is long, is 50% of the portfolio short? Is it a 130-30? What's sort of the mix of the long and short within the portfolio?
Yeah, so this particular fund would be classified as dollar neutral. So if you were to invest $100 in this fund, we'd go out and buy $100 of long equity exposure. We'd go out and short $100 of short equity exposure. As we all know, when we short something, we get cash from that, which is described as short proceeds. So the overall portfolio is going to have assets of $100 of long equity, $100 in cash, and a liability of minus $100 in that short equity exposure. The net of those three legs gets you back to the $100 that you initially started with.
Great, thank you. And then, Bill, there was one thing that I picked on that I thought was really interesting. So I loved your 3 points. One is, have an investment thesis. Two was how is it going to help client portfolios, and three was how to communicate it. So I want to go back to number two, because that seems like that's where a lot of folks could run into trouble, right? They have a great idea and they know how to talk about it, but they want to force it into client portfolios. Is that something that you've seen sort of in the past with your history of working in the liquid alternative space, that sort of people build a solution and then go find a problem for it? Or does it typically tend to work the other way, where there really is a problem, someone identifies an investment thesis, and then builds a solution for it?
I think what you find is a little bit of both. A lot of the solutions that you see coming out of this space are pretty much standalone portfolios. You wouldn't need to have your other, say, equity or fixed income exposure. Think of like a long short equity, which is net long. You're going to have exposure to core equity as you would want, and you're going to have other risk premium that are going to be in that portfolio in addition to that. The issue, though, is that most individuals are not going to give up their other allocations and put them all in, say, that one hedge fund that is properly diversified across them all. So for us, we kind of started backwards, and we said, okay, clients are going to have their existing core equity exposure as well as their fixed income. How can we best fit into what already exists, rather than building the perfect portfolio that solves the solution for everything? So it's a little bit different. I do think the other area where folks have some issues is uncorrelated doesn't necessarily mean negatively correlated. So when the market goes down, an uncorrelated fund could go up, it could go down. It's by definition uncorrelated. As a result, its returns are not going to have, what happens to the market will have no bearings on that particular fund's return. So as a result, a lot of individuals get frustrated when they add that uncorrelated return stream. All of a sudden the market goes down and this fund isn't going up. So I think you have to think through what it is that you're looking to add. And in most cases when we talk to clients, yeah, they don't like the cost of the insurance, but they sure like it when the market goes down significantly and this fund is up a lot. So we think of it as kind of a sleep well at night. I'm stealing that from somebody, I'm sure, but it resonates well with the folks that we talk to. John.
Thanks for that. So, Bill, I think you sort of hit on it in your answer there a little bit, my next question, so kudos to you. But you talked about uncorrelated doesn't mean negative correlated. What I want to talk about a little bit is what are some of the common misconceptions about liquid alts, and how have these been sort of disproven over the last either few weeks or last couple of years? I mean, especially at the end of 2019, we saw the volatility in December and that sort of stuff. But what are the common misconceptions that folks have in and around these types of products?
Well, we kind of hit on some of them. I think the biggest problem we have is because they are so diverse, they're so different across the whole spectrum, that at times people will kind of pick on one particular type of fund and think that applies to all of them. So most of them are very specific. I'll just cover a couple of the issues that we run into. What's very important with regards to these liquid alts is that you spend time educating, explaining what the drivers of the returns are, because depending on the strategy, these drivers could be very different. So a couple of just quick examples. We've seen a number of advisors offering strategies that are really more illiquid type assets, but they're putting them into a liquid vehicle. Just because you're putting them in an ETF or a mutual fund that trades every day doesn't necessarily mean that the liquidity that the vehicle has that you ported it into, the underlying assets are going to have the same level. So we've seen that time and time again, where there have been issues when the market kind of freezes up, that some of these more illiquid strategies that are now in liquid vehicles, they don't end up doing nearly as well as you might have thought. That's a common area where folks make some mistakes. The other areas is people tend to focus a lot on returns. So they're always looking to improve the returns that they're expecting. And they forget that at the end of the day that, you know, volatility is a big element as to how much money they're going to have. You know, we show them the basic arithmetic, but, you know, easily if you're down 50%, you have to be up 100% just to make that money back. So we spend a fair amount of time as we go through the various strategies that we tend to offer. But again, it's so important to understand what's driving the return so you understand why it's in the portfolio. I would advise that in many instances, the names on funds are not as informative as you might think. So it's important to get under the covers and make sure that you understand exactly what, you know, how this fund will perform in varying markets.
Thank you, Bill. That's great to hear. Certainly understand why you want to do your homework on these. You know, I have to think based on what you said, and hopefully you can give us an answer to this question here. Is, you know, there's tons of different alternative flavors, like you said, with lots of different products out there. Did they all do well during that sort of 6-month spike that we just had? Did other types of strategies perform better? Sort of, is that something you would look at and say an alternative didn't work at that time, and that's not a good product to hold? Or was it just maybe not the right alternative product for what took place in the market at that time? I don't know. I mean, that may be a bit confusing question, but sort of trying to get at, did all alts work during that time of volatility?
Yeah. So, you know, we like to cut things very finely. So we like to group things into various buckets in terms of what drives the returns, rather than just kind of lumping them all into a very large bucket with many different funds that have very different objectives. You what you will see is that, funds that had some short bias to them obviously did extremely well when the market was heading down over the course of late February through March. Obviously, as the markets come back over the last, say, week or so, it's been very much a high beta, low quality market. So funds that emphasize those types of characteristics have done exceptionally well. Again, we don't like to make generalizations and say, oh yeah, liquid alts did poorly or they did exceptionally well. It very much is dependent upon the strategy and the return drivers that were in that fund at the end of the day.
Thank you, Bill. I think Mark wanted to add something before. So Mark, if you had to jump in, please go ahead and add in your points. I apologize for missing you looking to jump in before.
Oh no, that's okay. I think Bill covered most of it. I would say just in top of that, some of the misconceptions that I've seen, I think that liquid alts have proven more recently. I'd say the first one is that you don't need liquid alts, and I think the performance of liquid alts recently during the down draft has shown that liquid alts are an important part of a person's potential strategy, and that they are useful. But it always looks different when the market's in a bull market. I think the other one that Bill did very well is he explained the strategy that we have. And I think a lot of the misconceptions are that, liquid alts are complex, difficult to understand. Yes, we build the portfolio to be very thought out, but as Bill explained it, we are capturing a spread between low beta and high beta. So that's something that, it can be very simple to be able to explain to people, although the put together can be, somewhat more complex. I think one of the other misconception we hear a lot is that a hedge fund doesn't have access to capital, but liquid alts, you get access to your capital because they are daily liquid. So that's just a few of the misconceptions that I hear sometimes when I'm out talking about liquid alts. Thank you.
Yeah, thank you, Mark. I think you bring up a great point with that, the liquidity that the ETF brings to it. As Bill mentioned, just because it is in an ETF doesn't mean that the underlying is liquid, but you should be able to trade in and out of your ETF. You may have a wide spread if the underlying's not liquid, but you certainly would have access to your capital. So this next question, I'll actually throw it out to both Mark and Bill, but Bill, why don't you go first? So one of the questions that I was wondering about is, does the speed and the shape of a recovery impact the returns that you're going to see on a hedge product? So if you had a quick V recovery, is that good for a product? Is it indifferent for a product? If you had more of a U-shaped return, what would that mean for hedge products? Does the rate and shape of the recovery matter to the performance of the liquid alts products and the hedge product?
Yeah, it goes back to what is driving the returns of that particular portfolio. If we just looked at the one we were looking at earlier that was long, low beta, and short, high beta, obviously the last few days we've been through a junk rally where low quality, high beta names have done exceptionally well. This particular strategy has struggled over the last few days. I think we've seen this happen a number of times since the product has been live in the U.S. over the last 10 years, and it's pretty much an indicator that the market is getting overbought. So from our perspective, just looking at the price action, we would suggest that the insurance is actually the cost of it is come down dramatically just over the last few days, given what we've experienced in terms of this very sharp, high beta, low quality rally over the last, it's basically been a week, John, that we've seen tremendous movement on some of these names. Really interesting what we've seen.
Yeah, who knows, this could only be the start. Go ahead, Mark.
And I would echo Bill's comments as well. I think the one aspect that we need to talk about, as Bill mentioned, depends on the strategy. There are different types of liquid alternatives as well. Some managers are opportunistic. So that opportunistic manager is going to change the long and the short. So depending on how they're positioning, how they're feeling about the market, what their signals are telling them, they may change their long and shorts. The difference in our strategy, and we are not opportunistic. It is consistent, long and short. Bill talked about it, dollar neutral, sector neutral. The reason that we've created that consistency is Bill talked about the outcome. He talked about what we're trying to do. By creating the strategy the way we do, advisors understand what they're getting, and they understand that when the market goes up, we tend to lag a little bit, but when the market goes down is where you get paid off on your insurance. So from our perspective, that's a very compelling attribute for advisors, because when they buy into the liquid alts, where they may be a little bit hesitant to step into it, they know what they're getting. With some of the more opportunistic strategies, you're relying on the manager and the signals and positioning properly for the market that we're in.
Mark, thanks for that. And I think you must be reading from my set of questions here, because the next question I have for both you and Bill is in regards to what do you need to look for in an alternatives manager. Obviously, when it comes to a hedge fund, people are looking at their returns, their strategy, who's the brains behind it. I would imagine that's got to be pretty similar when it comes to the ETF space as well. Am I wrong there? And Mark or Bill, feel free to jump in first.
I'll continue first, Mark, if that's okay. I'll say there's two important elements here, and it's very interesting because with the changes that have occurred in the rules in Canada, we've seen a number of mutual fund type companies trying to get into the liquid alternative space. Additionally, we've seen a number of hedge fund like companies trying to get into it. So you need a couple of things. One is you need to have experience managing hedge fund type strategies. And typically that means longs and shorts. Shorting within a registered product is a lot more complex than basically just doing it in a private account. There's lots of regulations that you have to follow. There's some arbitrage around actually physically shorting securities versus derivatives, so you have to have acumen with regards to both products. So you need to have hedge fund manager-like experience to manage these strategies. The other part that you need is you need to have the ability and all the systems in place to create daily NAVs, to create liquidity every day when clients want to get in and get out. Those systems are typically systems that are owned by mutual fund, ETF companies, whereas most hedge funds, are providing liquidity maybe once a month or once every once a quarter. So it's a very different process. So I would suggest that it is more difficult to find the right firm that has the right match of those hedge fund-like skill sets, as well as the ETF mutual fund daily NAV skill sets.
Mark, anything to add?
No, I think Bill covered it very well. Thank you.
All right. So I don't want to not leave enough time for infrastructure. So Bill, I'm sure we have some questions from the audience that we could bring you back in for in just a moment. But I do want to talk about your AGF Global Infrastructure ETF. It's done well in the market since its inception. Mark, can you kind of break down the infrastructure ETFs further, sort of explain the pros of adding them to a portfolio and how you guys are using them to add diversification to advisor portfolios at this time?
Yeah, thank you, and thanks for everyone joining it. And so, obviously, Bill talked about liquid alternatives, and now infrastructure is in that space of alternative asset that is useful for people's portfolio as well. And, infrastructure happens to be one of those key assets that has been the domain of institutional pension funds for many years. So I think one of the key differences is just to understand that the pension fund invests directly in infrastructure assets and projects, where the infrastructure ETFs invest in publicly traded stocks that directly or indirectly own and operate the infrastructure assets. Infrastructure ETFs, if you want to break them down a little bit more, they're certainly global. And then they invest in four main global sectors of the economy: transportation, utilities, energy, and then a fourth, if you want to call it, a combination of REITs, telcos, and financials, all associated with the infrastructure space. So the investor can invest in stocks. What you're getting the opportunity to do is invest in stocks that are normally not necessarily in a core equity portfolio ETF. For instance, airports and toll roads are invested in the transportation sector. Emerging markets, electricity providers in utilities. Certainly pipelines are within the energy space. But then you have data centers that are within the REIT sector, as well as towers within the REIT sector. So when you're looking at what the infrastructure ETF is, it is really the combination of four sectors that are the backbone of the global economies and global growth. And they really allow to generate a difference between what a pension fund is and what we invest in, but still getting access to the infrastructure space. And then in terms of benefits, I'm going to turn to slide 6 in the deck and start to talk a little bit about the benefits that we have. Certainly, there's a number of benefits. I'm going to highlight a couple, and I have additional slides on it as well. One of the big benefits of infrastructure and owning infrastructure through an ETF is the stocks they have a lower correlation to major equity and fixed income markets, and I'm going to show you a slide on that as well. Much like we talked about liquid alts, we're looking for something that's less correlated to our core equity. So they are a very good risk diversifier to our existing core portfolios. The other aspect that is a very good benefit to the infrastructure assets is these are, as I said, you're investing in stocks that own assets for a long time. And they are going to be more defensive, and because of that, the certainty of the asset, they're able to pay a very attractive dividend, and so these stocks have a very good yield that goes with investing in this space. And then the third one, as I mentioned, that they tend to have lower volatility because of the certainty asset, because of the type of assets we're investing in. You get a risk management because of that lower volatility. And then the final benefit is it's pretty well publicized that you're going to have a lot of infrastructure spend over the next number of years. It's billions, it's trillions, and these are going to be assets and companies that are going to benefit and be able to invest in those areas that you're going to see the infrastructure associated with it. And I'd also say more recently, one of the aspects that has come out of the infrastructure space is with the current situation with social distancing and working from home, we're actually also noticing to see that infrastructure stocks can play a part of that theme as well. With 5G and stay-at-home trend, within that other category, I mentioned we had telcos and we have cell towers, all going to benefit from the stay-at-home, the demand for data, as well as REITs that have demand for data as well. So it's not just going to be the long term, but you're also getting the shorter term theme as well that we're seeing more recently from the stay-at-home. And I just want to highlight, I mentioned a couple of the aspects that go with the infrastructure and the benefits. The first one is the lower correlation to major equity classes and fixed income classes. And that's why we invest in it, because we want to make sure that we get a lower correlation and that risk diversification. And so in this case, you can see the infrastructure ETF and the infrastructure stocks are very much have lower correlation to the broad equity market, broad fixed income market. And so you get that, and it's consistent. It's not just over a short-term period, it's over a long-term period. So it's something that you're going to get over a very long-term period that you can add to your core portfolio and get the benefits of lower risk. With that, I'm going to turn it over to you, John, and see if you have any other questions as well on the space.
Oh, yeah, absolutely, Mark. We're just getting started, so I appreciate you opening up for questions. But, one of the things that's coming up is I know that you've talked about sort of a little bit about how the strategy works, but what differentiates from others out there? Are there currently many infrastructure ETFs in Canada? What makes yours unique relative to the rest?
Yeah, that's. I would say that the infrastructure space in Canada is still pretty early on. There are a number, but certainly not to the extent of some of the other areas. So it's still a area that's very early on, and an opportunity to add value within the space. And I'd say one of the things that we notice within some of the other ETFs, so certainly there's an element of some of them are passive, and so they're benchmarked versus a common index within infrastructure. And a number of them will also have either a focus on North America in particular, so they're either Canada, US focused, or they have a sector focus. And what's different about the AGFiQ ETF is first, it's active. It is well diversified across the globe. It's a global, and it's also diversified across all the sectors. But by being active, we're also going to change those positions, change our stock positions, change our regional positions. But what's also unique about AGFiQ is we are a quantitative manager, so we use models to identify the most attractive sectors and stocks within the infrastructure space, and we are very much focused on better risk-adjusted returns when we compare it to a passive index. And there are a number of unique aspects that I can start to talk a bit about the AGFiQ ETF as well. I mentioned that we are very much active. We're quantitative. One of the things that we have done that's unique is we created our own unique global infrastructure universe. So our universe is we've gone out and created a bigger pool of candidates to choose stocks from. We do start with what's called the Dow Jones Brookfield Global Infrastructure Index. But as I said, we started to look globally and realized there was an opportunity to look for infrastructure-related stocks in many of the markets that people wouldn't think about. And so our universe of stocks that we're building from is 350 stocks. As I mentioned, we are quantitative. We look at different sectors. Our entire process is quant, multi-factor. It's proprietary. What that means is that when we're using multi-factor, we're looking for the fundamentals or the drivers of returns. Bill talked about that as well. And those are drawn from income statements, balance sheets, cash flow, and the volatility of stocks. And we're actually then customizing our stock selection models, which help us identify the most attractive stocks in each sector. And we do that for each of the different major infrastructure sectors. So we have a stock selection model for utilities, for energy, transportation, and that group that collects REITs, financials, and other. And so we are constantly looking for the best opportunity within the space, and we're looking for stocks that have obviously also have attractive yields within the space as well. As I mentioned, it's active, so throughout we are changing our positions within stocks and within the sectors over time.
Mark, thank you so much for that. So we're getting up to our kind of last 10 to 12 minutes here, so maybe we do a little bit more of a speed round here. So I think one of the questions we always get from advisors is, okay, if I'm going to allocate to infrastructure, should I be taking that from my equity portfolio? Should I be taking it from my fixed income portfolio? Should it come from somewhere else? Mark, what would your thoughts be on where they may want to consider possibly, selling a position to raise capital for an infrastructure ETF?
Yeah, so I think, one of the things we talked about is the fact that it has, lower correlations to both fixed income and equities. So it really does depend on the individual portfolio, the advisor, and their investment objectives, because it can be both. Because if we step back and look at the market right now and where are opportunities, one of the aspects of infrastructure is it generates yield. Yield is definitely in the equity market, and the infrastructure stocks are known for the yield and have attractive yields. So infrastructure can very much be a good equity diversifier for your core portfolio. But it can also do the same thing from when you look at your fixed income, because the bond yields are low, certainly government bonds, and if someone's using GICs or some other lower yielding product, there's the opportunity to add in a lower volatility equity such as infrastructure and take away from your fixed income, and it is very much complementary to your existing fixed income, but also very complementary to your equity portfolio. So there really is the opportunity for both, depending how you want to structure your portfolio, because of the versatility of infrastructure stocks and the fact that they have lower correlation to both the equity and the fixed income market.
Great answer, Mark, for that. I think to me that sounds like, hey, if you're an advisor and you have a question, you probably want to talk to an AGF representative to just sort of understand what the impacts might be to a portfolio. And I always encourage any advisor who's thinking about adding any type of product to their portfolio that they certainly have a conversation with that ETF issuer to understand what the experience would like. So I want to dive into some audience questions. So I think this question is probably more for Bill, just based on when the time it came in. But Mark, certainly, if you have something to say after Bill, just let me know, and we'll leave time for you there. But it's asking, do you take direct short equity exposure, or do you do it through derivatives?
Yeah, so presently, the Canadian product gets 100% of its short exposure through derivatives. We had petitioned the regulator and asked them if we could do it through physical shorts, and we have approval. We're working through the legal documents now so we can enact that. It's a little less expensive to do direct shorting versus through derivatives. So I would imagine that, you know, in the not too distant future, we'll be transitioning to more direct short exposure, which is how we've managed the product for almost the last 10 years in the U.S. What I will say is that we do, in the U.S. product, if we were going to make them more similar, we do tend to have a small derivatives position, and it just allows us to help manage the cash a little bit better. John.
Mark, anything that you would add to that?
No, I wouldn't add anything. Thanks, John.
All right. So when we're talking about these different strategies and these different products, you know, one of the things that obviously comes up with ETFs all the time is low cost and access to a wide range of the market. What are the costs on these two products? Mark, why don't you go first to talk about the infrastructure product, and then Bill, you can come in with the neutral product after that.
Yeah, so one of the aspects about ETFs, when you don't have the associated costs with them, is they are fairly inexpensive. And so the infrastructure ETF has a management fee of 45 basis points.
And the market and the QBTL would be 55 basis points.
And relative to competitors, is that in line? I mean, for the types of strategies, to me, that sounds a very, very reasonable price ETF. Where do you guys sort of sit across the gamut from a pricing standpoint?
Yeah, we're definitely trying to be attractive. Go ahead, Mark.
Yeah, so both of those strategies are both of those strategies are definitely competitive versus the peer group. And one of the reasons we did is they are very much attractively priced when you compare them to the competitor group. I think Bill was about to say the same thing.
Yeah, this is new for us, so we're trying to grow assets. So we're definitely trying to price it attractively for investors.
Yeah, absolutely right. With ETFs, we do know investors are looking at the price tag. I always believe, though, price is only a concern in the absence of value, and both of these products add a ton of value to any investor's portfolio. So the next question here, this one's a little bit tricky. It's what percentage do you suggest we add to an all-equity portfolio to make BTAL's contribution meaningful, not in terms of returns, but maybe from a higher Sharpe ratio? I don't know if that's exactly what they mean by the question, but that's how it's written.
Yeah, so
Bill,
I'm going to I'll quickly jump through two slides. Hopefully I did it correctly, John. I popped up slide 11 here. So it's very dependent upon the client, as Mark alluded to, in terms of their, are they a conservative investor? Are they an aggressive investor? If we look at this particular slide, it highlights what a blend with, say, core equity. This is fairly an academic exercise in that we took the returns associated with the SPDR, SPY in the U.S., and we blended them with the U.S. version of BTAL at various blend levels. And we show you what the beta of that portfolio looks like, as well as its Sharpe ratio. And we show you what the drawdown would look like on the right-hand side of those particular blends. So obviously, if you're a more conservative investor, you're going to own more BTAL and less core equity. If you're a more aggressive investor, you're going to own more equity and less BTAL. I think, the other slide that I'd like to quickly go to is just the next one. And it just takes a very specific example. In this case, we're trying to compare it to a more traditional 60-40 balanced portfolio, which is 60% in equities, 40% core equity. The way we've created that portfolio, again, is a quarterly rebalance of SPY, the index actually, in this example, as well as 40% to the old Lehman Ag bond index. So you can see the risk-return profile of that balanced portfolio here on slide 9. And if you looked at, say, a 75% allocation to core equity and 25% allocation to BTAL, you could see that it compares very favorably with regards to risk. It's a little bit higher, but it has a higher return over this period. I think what's interesting is what happens when you combine a negatively correlated asset. They both have very similar volatilities if we look at the volatility of the market as well as BTAL, but when we blend them together, we end up with something that has almost half the volatility. So really interesting exercise at 75-25. You can keep, more than 3/4 of the return, but you can cut the volatility and drawdowns almost in half. So a good example, we've been out talking to clients from a more tactical perspective about maybe reducing some exposure to fixed income. Fixed income is it's a great asset class. It's really good for mitigating risk and volatility, but with yields as low as they are, the return expectations have come down significantly. But more importantly, I think folks forget that when yields come down, durations extend, so that risk mitigating asset class is not nearly as mitigating as it was, say, over the last 10 years. So we've been having serious conversations about that, just trying to make sure that folks are aware, given that we're at record low yields at this point, that fixed income asset class is probably a lot riskier than you thought it was, relative to its own history. Thanks, John.
Oh, no problem. So with that, we're just about out of time. I want to thank both Bill DeRoche and Mark Stacey for joining us today. I want to thank all of those that have submitted questions and all of those that have joined in and listened to today's webinar. As I mentioned at the start, there will be a replay available within approximately 24 hours of the conclusion of today's webinar. You will be emailed that reminder, and you can use the same link that you used today to go ahead and access that replay if there was anything that you missed. Again, a big thank you to AGF and AGFiQ for helping to support today's educational webinar as we try to remove some uncertainty and risk from client portfolios as we push further and further into 2020. I would remind everybody to join us again tomorrow morning at 10 a.m. We're going to be taking a look at fixed income and some different solutions that you can have both domestically in Canada as well as taking a global approach. Again, that will kick off at 10 a.m. tomorrow morning, and that's part 3 of our 5-part webinar series. So make sure that you join us for that. If you haven't done so, please go ahead and register. And then again, a very big thank you to Bill and Mark for their time and consideration today. I appreciate it. Everybody have a great day, and we'll see you tomorrow at 10 a.m. Thanks again, and have a great rest of your day.